All right, so you're hoping to turn like $10,000 into a passive income machine using dividends.
Right.
Well, we're going to jump into this deep dive and see what we can uncover. We're looking at this article.
Yep.
It's called Why Buy Useless Crap When You Can Invest $10,000 for FAT Dividends.
I like it.
The title definitely grabs your attention.
Yeah.
It's playful, right?
It is.
Makes you kind of want to keep reading.
For sure.
And you're specifically interested in how to make dividend investing work with that $10,000.
This is a fun and engaging article that really tackles some key misconceptions about saving for the future. And I think it really does set the stage for understanding the power of dividend investing, especially when you're starting with a specific amount in mind.
Yeah, so it comes out swinging.
Right.
It claims that saving alone is for chumps.
Okay.
Low interest rates, inflation, all that.
Yeah.
It argues that the money you stash away in a savings account is actually losing value over time.
Yeah.
That's a pretty bold statement.
It is bold.
Yeah.
But there's truth to it.
Okay.
Back in the day, your grandparents could park their money in a savings account, earn a decent return.
You're right.
Those days are gone.
Yeah.
Interest rates are near historic lows, making it nearly impossible to outpace inflation through savings alone.
So if saving alone isn't the answer, what's the alternative?
Yeah.
This article seems to be all about dividend stocks.
Okay.
As the OG of passive income.
Right.
Getting paid simply for owning a piece of a company.
Yeah, that sounds pretty good.
Dividend stocks offer a way to make your money work for you.
Yeah.
So instead of it just sitting there,
Right.
your money is actively invested in companies that generate profits and then share a portion of those profits with their shareholders.
Okay, but not all companies pay dividends.
Right?
How do we differentiate the good from the bad?
Okay.
This article dives into two main categories: dividend aristocrats and high-yield stocks.
Oh, nice. Dividend aristocrats sound like royalty in the investing world.
They kind of are. Think of them like the blue bloods of the stock market.
Interesting.
Companies that have consistently increased their dividend payouts for at least 25 consecutive years.
Wow.
These are the stalwarts.
Okay.
The reliable giants like Coca-Cola,
Yeah, classic example.
Procter & Gamble, Johnson & Johnson.
Yeah.
They're known for their stability,
Oh.
steady growth, commitment to rewarding their shareholders.
So if you're looking for dependability, track record of success,
Yep.
dividend aristocrats are a good place to start.
Absolutely.
This article also mentions high-yield stocks.
Oh,
Sound almost too good to be true.
well, as with most things in life, there's a trade-off.
Right.
High-yield stocks offer those juicy, tempting dividend payouts.
Right.
They can really catch your eye.
Yeah.
But remember, high yields often come with higher risk.
Okay.
So if a company's offering an unusually high dividend, it could be a sign that they're struggling financially
Oh.
and trying to attract investors with a big payout.
So we need to be cautious, do our research
Yes.
before jumping on those high-yield stocks.
Exactly.
The article gives this example. You invest your $10,000 in a stock with a 5% dividend yield.
Okay.
That would generate $500 annually.
Mm-hmm.
That's a decent chunk of change.
Right.
But then it says that picking individual stocks,
Yeah.
especially for someone new to this game, can be overwhelm.
It can be.
Is that where ETFs come into play?
That is exactly where ETFs come into play.
Okay.
So ETFs, or exchange-traded funds,
Yeah.
are like a prepackaged basket of stocks.
Okay.
So instead of picking individual companies, you can invest in an ETF that focuses specifically on dividend-paying stocks.
Oh.
So it's a way to instantly diversify your portfolio and reduce your risk.
So ETFs are like a one-stop shop for dividend investing.
Yeah, I like that. That's a good way to put it.
But there are so many ETFs out there. There are. How do you even begin to choose? The article recommended 3 specific ETFs. Vanguard High Dividend Yield ETF, that's VYM, SPDR, S&P Dividend ETF, SDY, and iShares Select Dividend ETF, or DVY.
All right. What makes these stand out?
So these 3 are popular choices among dividend investors because they offer slightly different approaches.
Okay.
So VYM focuses on large, well-established companies that pay high dividends. You get that stability and a decent income stream.
Gotcha.
SDY zeroes in on companies with a long history of increasing their dividends,
Okay.
like those dividend aristocrats
Okay.
we're talking about.
Right.
And then you got DVY,
Yeah.
which aims to strike a balance between yield and risk,
Okay.
focusing on companies with Good, but not excessively high yields.
So it sounds like there's an ETF out there.
Yeah.
For everyone's risk tolerance and investment goal.
I think so.
What kind of returns are we talking about with these ETFs?
Right.
The article uses VYM as an example.
Estimates that a 3% yield on a $10,000 investment would generate $300 per year.
Okay.
Not as flashy as that 5% yield from an individual stock, but less risky.
That's the trade-off.
Okay.
So ETFs tend to offer more moderate yields compared to individual stocks.
Right.
But they provide that built-in diversification.
Gotcha.
And generally lower risk.
Okay.
And remember, those dividends can grow over time as the companies within the ETF increase their payouts.
All right, now on to something a little more tangible, real estate.
Yeah.
This article presents REITs as a way to become a landlord without the hassle of dealing with actual tenants.
That's a great way to put it.
It calls it landlord life without the actual tenants.
Yeah, I like that.
So instead of buying a rental property, dealing with all the headaches that come with it, I can invest in a REIT and essentially own a piece of those properties.
Exactly.
Why do REITs tend to have higher dividend yields than other investments?
That's because REITs, or real estate investment trusts, are legally obligated to distribute at least 90% of their taxable income to shareholders in the form of dividends.
So more dividends for us.
That's right.
But the article differentiates between two main types of REITs, equity REITs and mortgage REITs, or MREITs.
Okay.
Does it matter which one we choose?
It definitely matters.
Okay.
So equity REITs, as the name suggests, own and operate physical properties.
Okay.
So they generate income from rental payments and property appreciation.
Gotcha.
They're considered a more stable option.
Okay.
Especially if you're looking for long-term growth and consistent dividend income.
MREITs invest in mortgages and mortgage-backed securities.
That's right.
They make money from interest payments and capital gains. So what's the catch?
Well, the catch here is that MREITs are more sensitive to interest rate changes.
Oh.
So if interest rates rise, their earnings and dividend payouts can be negatively impacted.
So it's a classic risk-reward scenario.
Is.
Higher potential returns often come with higher risks.
Yeah.
The article gives examples of two specific REIT options.
Okay.
Realty Income Corp and Vanguard Real Estate ETF, VNQ.
Okay.
Why these two?
Realty Income Corp is a popular choice.
Okay.
Because it's known for its consistent monthly dividend payouts.
Oh, wow.
They have a long track record of paying dividends like clockwork.
Nice.
VNQ, being an ETF, offers broad diversification across various property types.
Makes sense.
It's a good option if you want to spread your risk across the entire real estate sector without picking individual REITs.
The article provides another enticing example. A REIT with a 6% yield could generate $600 annually from a $10,000 investment.
Nice.
That's double what we saw with that VYM ETF.
Yes.
But before we get carried away, we need to understand the risks.
Absolutely. While REITs can offer attractive yields, it's essential to research the specific REIT you're considering.
Okay.
Analyze its portfolio and assess its financial health.
So we've explored dividend aristocrats, high-yield stocks, ETFs, and REITs. Is there anything else out there in the dividend investing world?
Oh, there's a lot out there.
Oh, okay.
I noticed the article mentions dividend growth funds.
Dividend growth funds are a fascinating option, especially if you're in it for the long haul. These funds focus on companies that have a history of consistently increasing their dividends year after year.
So it's not just about chasing the highest yields right now.
Right.
It's about investing in companies that have the potential to grow their dividends over time.
Exactly.
And that translates into a growing passive income stream for us, right?
That's the idea.
The article mentions Vanguard Dividend Growth Fund, VDIGX, is a prime example.
Right.
What makes this fund stand out?
So VDIGX is known for its focus on high-quality companies with a track record of dividend growth.
They prioritize stability, consistent earnings, and a commitment to rewarding shareholders.
Now I'm starting to feel a little overwhelmed with all these different investment options.
It's a lot, yeah.
Is there a strategy for combining them?
Yeah, so...
The article mentions building a diversified dividend portfolio.
Okay.
What does that mean?
So diversification is key to managing risk and maximizing returns.
Okay.
Instead of putting all your eggs in one basket,
right,
you're spreading your investments across different asset classes.
So if one investment underperforms, others can help offset those losses.
Exactly. That's the goal.
So it's about not putting all our faith in one type of investment, spreading the love.
Yep.
The article even suggests a sample portfolio allocation.
Yeah.
30% to dividend aristocrats.
Okay.
30% to a dividend ETF, 20% to REITs, and 20% to a dividend growth fund.
Gotcha.
That sounds pretty balanced.
Yeah.
How do we know if this allocation is right for us?
That's a great question. Remember, everyone's financial situation and risk tolerance are different.
Okay.
This sample allocation is a good starting point, but it's important to tailor it to your specific needs and goals.
So it's not a one-size-fits-all solution.
Right.
It's about understanding the different investment options, assessing our own risk tolerance, and crafting a portfolio that aligns with our financial goal.
I think that's a great way to put it.
This article estimates that this sample portfolio could generate around $320 in dividends in the first year, with the potential for significant growth over time as dividends increase, and the portfolio compounds. That compounding word keeps popping up.
Compounding is like magic.
Okay.
But for your money, it's the snowball effect of earning returns on your returns.
Okay.
So think about it this way. You invest $10,000.
Yeah.
And you earn $300 in dividends the first year. If you reinvest those dividends, you're now earning dividends on $10,300.
Gotcha.
The next year, you earn even more dividends.
Right.
And those dividends earn even more dividends.
Okay.
Over time, this creates exponential growth.
That's pretty cool. The article really emphasizes the importance of reinvest in those dividends instead of cashing them out.
Reinvest in dividends is like adding fuel to the compounding fire.
Okay.
It allows you to buy more shares, which in turn generate more dividends, creating this powerful cycle of growth over time.
And the article mentions something called dividend reinvestment plans, or DREPs.
DREPs are like autopilot for dividend reinvestment.
Okay.
So they automate the process of using your dividend payments to buy more shares.
So it's a set it and forget it approach.
It is.
That sounds pretty convenient.
Yeah.
But this article seems to be all about patience.
Yeah.
Taking a long-term approach.
It is a long game.
It even says, don't be a portfolio peaker.
It's a good reminder that dividend investing is not a get-rich-quick scheme.
Right.
It's a long-term strategy that requires patience, discipline, and a focus on steady growth.
So it's about trusting the process and understanding that building a sustainable income stream through dividends takes time.
It takes time, that's right.
And that's where things get even more interesting.
Okay.
Join us for part 2.
Sounds good.
Where we'll dive into another crucial aspect of dividend investing, taxes.
Welcome back to our deep dive into dividend investing. In part 1, we explored all those different ways to generate passive income, with dividends from those dependable dividend aristocrats to those more adventurous REITs. But there's a crucial piece of the puzzle we haven't really tackled yet.
Okay.
Taxes.
Right.
It's easy to get caught up in the excitement of all those potential returns.
Yeah.
But understanding those tax implications can make a huge difference in your net gains.
Absolutely.
Like this saying, it's not what you make, it's what you keep.
That's a great analogy. And you're absolutely right. Taxes play a significant role in dividend investing.
Well, the good news is that dividends are generally taxed at a lower rate than your regular income.
Okay.
There are definitely some nuances to keep in mind.
Okay.
So let's break it down.
All right. I'm ready to dive into the tax maze.
Okay.
This article mentions something called qualified and non-qualified dividends.
Right.
What's the difference? Why should we care?
It's not as complicated as it sounds.
Okay.
So qualified dividends, those are dividends that meet certain criteria set by the IRS and get taxed at a lower rate.
Okay, so lower taxes. That's always good.
It's always good.
What makes a dividend qualified?
All right, so to qualify for that preferential tax treatment, the dividend must be paid by a U.S. corporation or a qualified foreign corporation.
Okay.
And you need to have held the stock for a minimum holding period.
Oh.
Typically, it's 61 days for common stock and 91 days for preferred stock.
So no quick flips for those lower tax rates?
No quick flips.
What about non-qualified dividends?
So non-qualified dividends don't meet those specific criteria.
Okay.
So they're taxed as ordinary income.
Oh, okay.
So that means they're subject to your regular income tax rate.
Oh, okay.
Which can be higher than the preferential rate for qualified dividends.
So qualified dividends are good?
Yeah.
Non-qualified dividends, not so much?
Not so much.
I know that investing in a tax-advantaged account, like a Roth IRA or a 401k, can have some serious tax benefits.
Yeah.
Do these benefits apply to dividend income?
Absolutely.
Okay.
One of the biggest perks of those retirement accounts is that any dividends you earn within those accounts are either tax-deferred or tax-free.
Okay.
Depending on the type of account.
Can you elaborate on that?
Sure.
I'm all about maximizing those returns.
Of course.
And minimizing my tax bill.
So with traditional IRAs and 401ks, your contributions are often tax-deductible up front. And any investment growth, including those dividends, is tax-deferred.
So you won't owe taxes on those dividends until you withdraw the money in retirement.
Exactly.
That's awesome.
It's a fantastic way to let your investments grow and compound without the drag of taxes.
What about Roth IRAs?
So with a Roth IRA, you contribute after-tax dollars.
Okay.
So you've already paid taxes on that money.
Right.
But here's the beauty of it. Qualified withdrawals in retirement, including those dividends, are completely tax-free.
So it's a trade-off.
It is.
You pay taxes up front, but then you get to enjoy those dividend payments tax-free in retirement.
That's right.
Yeah, it's a great deal.
It's a great strategy for long-term planning.
Yeah.
Especially if you're early in your career and you anticipate your income and your tax bracket to rise over time.
Right.
So you're essentially locking in that 0% tax rate on your dividend income for retirement.
If we're playing the long game with dividend investing, it seems like holding those investments in these tax-advantaged accounts is a no-brainer.
It's hard to beat.
What if we've already maxed out our contributions to those accounts?
Right.
Or what if we're investing for goals outside of retirement, like a down payment on a house or a dream vacation?
Sure.
Are there any tax strategies we can use in those cases?
There are a few things to consider.
Okay.
So remember those qualified dividends we talked about?
Yeah.
Well, focusing on investments that generate those qualified dividends can make a big difference come tax time. Since they're taxed at a lower rate, it can help reduce your overall tax liability.
So being selective about the types of dividend-paying investments we choose can pay off.
It can.
Literally.
Literally.
Yes.
Another strategy, especially if you have a taxable brokerage account, is tax loss harvesting.
Yeah.
Okay, what's the gist of that?
Imagine you have some investments that have, lost value.
Right.
It happens to the best of us.
Happens to everyone.
Well, with tax loss harvesting,
you can strategically sell those losing investments to offset any capital gains you might have.
Okay.
Including those from dividend income.
That sounds pretty clever.
A nice little strategy.
But I'm guessing it requires some careful planning.
It does.
And maybe even professional guidance.
It's always a good idea to consult with a tax professional to make sure you're doing it correctly and maximizing those benefits.
This whole tax thing can feel a bit overwhelmed.
It can be a lot.
It seems like there's so many moving parts to consider.
There are a lot of different factors.
Yeah.
But the key takeaway is that understanding the tax implications of dividend investing can make a big difference in your overall returns.
Right.
By being strategic about how you hold your investments, focusing on qualified dividends, and potentially utilizing strategies like tax loss harvesting, you can minimize that tax burden and keep more of your hard-earned money.
Well said. It's not just about picking the right investments.
It's about understanding the whole picture.
Yeah. Taxes are a big part of that.
Now, before we wrap up this part of our deep dive,
I
think it's time to tackle another crucial aspect of investing, risk management. After all, no investment is entirely risk-free, right?
That's right.
Join us for part 3, where we'll explore the potential risks associated with dividend investing.
All right.
And discuss strategies to protect your investments and your financial future.
Welcome back to our deep dive into dividend investing. We've covered a lot of ground from picking those dividend-paying superstars to navigating the tax maze.
Yeah.
But there's one more crucial aspect we need to tackle.
Okay.
Risk management.
Right. Got to manage that risk.
It's like that safety briefing you get before a roller coaster ride.
Exactly.
You're excited for the thrills.
Right.
But you also want to know you're strapped in.
Oh, sure.
And secure.
Yeah. So we often get caught up in the potential rewards of investing.
Right.
But managing risk is equally important, especially when it comes to building a sustainable income stream through dividends.
Exactly. This article doesn't sugarcoat things.
Yeah.
It warns about those dividend traps.
Those are dangerous.
Yeah, those investments offering sky-high yields.
Right.
That could be flashing warning signs.
It's tempting, but gotta watch out.
How can we avoid falling for those too good to be true scenarios?
It all comes down to due diligence.
Okay.
Don't let those tempting yields blind you to the underlying risks.
So it's not just about chasing the highest number.
Right.
We need to look beyond the surface.
Exactly.
Okay, so what should we be looking at?
You want to delve into the company's financials,
Okay.
scrutinize their business model, and dissect their dividend payout history.
Okay.
Look for consistency and sustainability.
Gotcha.
If a company has a history of cutting or suspending its dividends, that's a huge red flag.
Okay.
Proceed with caution.
What specific financial metrics should we be looking at?
Think of it like checking someone's credit score before lending them money.
Okay.
You want to make sure they're financially healthy and capable of paying you back.
Right.
So you want to look at the company's debt levels, their profitability, their cash flow. These are the vital signs that tell you if they're in good shape to keep those dividends flowing.
Gotcha.
If a company's drowning in debt or their profits are shrinking, they might be forced to cut those dividends, no matter how attractive they seem up front.
So it's about looking beyond the flashy numbers and really understanding the company's financial health.
Exactly.
Now, this article emphasizes the importance of diversification for managing risk.
Big one.
It suggests building a portfolio that includes a mix of different asset classes.
Okay.
Why is diversification so crucial here?
Diversification is like your investment safety net.
Okay.
By spreading your investments across different asset classes, you're essentially creating a buffer against market volatility.
Okay.
If one investment takes a hit, others can help cushion the blow.
So it's about not putting all our eggs in one basket.
Precisely.
Okay.
Diversification helps you ride out those market storms and reduces the risk of those, gut-wrenching losses.
This article calls out REITs as an asset class that can add diversification to a dividend portfolio. But it also mentions that certain types of REITs, particularly those mortgage REITs or MITSs, can be a bit riskier.
So REITs are a different breed.
Okay.
They invest in mortgages and mortgage-backed securities, and their performance is heavily influenced by interest rate movements.
Okay.
When interest rates rise, REITs' earnings and those juicy dividend payouts can take a hit.
Right, so they're more volatile.
Yeah, they can be more volatile than equity REITs.
What about something called concentration risk?
Concentration risk is like putting all your chips on one number at the roulette table. It happens when a portfolio is heavily tilted towards a single company industry or even geographic region.
So even if we're diversifying across different asset classes, we still need to make sure we're not overly concentrated within those classes.
It's like having a well-balanced meal.
Okay.
You don't just want all protein or all carbs.
Right.
You need a variety of nutrients.
It sounds like managing risk in dividend investing is a multifaceted beast.
It is.
It's about doing our research, diversifying our holdings, and understanding the specific risks associated with each investment.
Risk management isn't a one-time task.
Okay.
It's an ongoing process. It's like tending a garden.
Okay.
You need to consistently monitor your investments, stay informed about market conditions, and make adjustments as needed.
Any final nuggets of wisdom?
Yeah, I think remember that risk tolerance is personal.
Okay.
What feels comfortable for one investor might be terrifying for another.
Right.
So assess your own risk tolerance honestly.
Okay.
And don't be afraid to seek professional advice.
Right.
If you need help crafting a risk management strategy that aligns with your goals.
This has been an incredibly insightful deep dive into dividend investing.
It has been fun.
We've learned that building a sustainable passive income stream through dividends isn't just about picking the right investments. It's about understanding the whole ecosystem.
It's about being a savvy investor, one who does their research, diversifies their portfolio, and stays ahead of the game.
And most importantly, it's about enjoying the journey.
Absolutely. It's about creating a financial future where your money's working for you, generating that passive income, and helping you achieve your dreams.
A huge thank you to our expert.
Thanks for having me.
For guiding us through this fascinating world of dividend investing.
Of course.
And to our listeners, remember that knowledge is power. The more you understand about dividend investing, the better equipped you'll be to make informed decisions, manage risks, and ultimately build that passive income stream you've been dreaming of.
That's what it's all about.
Happy investing, everyone!